Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Adam Grimes on the line. He's a Chief Investment Officer at Waverly Advisors. Adam, how you doing this morning?
Doing very well. How are you doing this morning?
We're doing good. We got rid of some of that snow. Got a full crew in here, so we're ready for the rest of the week. Adam,
Excellent.
I just want to get your background here a little bit. In the industry, you've been a trader, an analyst, and a system developer. Just give us a quick recap and how you ended up in your current position.
Sure. Well, I think one thing that is a little bit different about me is that my approach is a blend of quantitative and discretionary trading. You know, I'm not a black box trader, not an algo trader, but I'm also not a purely discretionary trader. I started as a trader for my own account. I was trading on my own, had pretty much no clue what I was doing, figured out which way was up, spent a few years at the New York Mercantile Exchange, and now I run Waverly Advisors, and we publish research for individual clients and institutions, and we're also launching some asset management here in the very foreseeable future. Cover everything from broad markets down to individual stocks, and that's pretty much the very high-level overview there.
Okay, interesting point here, because I saw that you're a systems developer, and
Yeah.
I definitely have spent some coin trying to develop automated trading strategies, and I come up with a lot of them. Haven't found the holy grail yet, but I also noticed that discretion really becomes a big part of it, and not taking a signal, refusing to take a signal, or doubting what you do. How do you get over that hump?
Well, there is no holy grail. I think everybody knows now. That's when I started 20 years ago. I think the level of education, the level of knowledge was much lower. People were looking for the holy grail. People thought there was some magical system, and it was relatively easy for people to sell things to the public to get people to waste their money on things. Now everybody knows, as you said, there's no holy grail, and the key really is finding something that has a very small edge and applying that edge with proper risk management, which means you're taking, more than anything, that means you're taking the right size bet for your account. You're not betting too big. And you do, one of the things that makes system development very difficult is what we would call regime change, where you find something that works in the market and then something changes in the market and erodes that system. One of the ways we can work around that is by trading things that are based on price tendencies that don't change. So you're looking for things like you're trading on momentum, you're looking to trade on pullbacks, you're looking to trade mean reversion where things snap back. As long as you're structuring your trades around those principles and your systems work around those principles, that's something that's going to be enduring. But if you're looking at sentiment, if you're looking at seasonality, if you're looking at quirks of price patterns, then you have something that might work well in backtest and probably won't carry forward so much. So I guess focus on the big picture within, and what that means is how markets usually move, and then you have a little better chance of having something that will have an enduring edge.
Okay, well let's talk about those three categories of trades, and for your systems that you design. And do you, just real quickly, do you put any fundamentals in there, or you look at all at the technicals?
Well, people do both, of course. As you know, my approach has evolved over the years into a pretty purely technical approach. For the reason is simply that that's what works on my time frame. I am what I would call an intermediate-term swing trader. In most cases, I'm looking inside of 2 months for trades. I'm also not a day trader, not a very short-term trader. So kind of that 2 weeks to 2 months is kind of the sweet spot for me. Within that time frame, fundamentals are very problematic. You will find cases where, earnings, great example, where fundamentals will change and something will move in response to fundamentals. But if you're doing a lot of modeling, if you're trying to find an edge based on fundamentals, you really need to be looking at longer time
Longer
horizons.
time frames.
And it's just a little bit outside of my viewpoint.
Okay, so let's go to these three categories. Pullbacks. Are there?
Sure.
We've had a pullback in the market. Are there any stocks here that are providing a setup, or sectors here that are providing a setup here where you're buying on a pullback, or an uptrend? You're finding some support. Could you give us any setups for today, or over
Well,
the next week or so?
yeah, I'll tell you something that I am really focusing on. There is a good potential setup in gold. And so we're looking at GLD, we're looking at gold futures. By extension, we could also look at any number of gold stocks, GDX, if you want to go there. This is a situation where it's a complicated situation, because I think in the very long term, so you're talking a year out, you're probably looking at more downside for gold. Does not mean we can't have a very nice, 10, 15, 20% run to the upside in the meantime. And we had a really excellent pullback on the daily time frame, where gold ran up at the beginning of the year, spent a couple weeks here pulling back. A lot of people don't really know what to make of it. That's one of the nice things about trading pullbacks. You start watching markets when everybody else stops paying so much attention to them, and that's where there really is the kind of coiled potential in the market. So I would watch gold. I would watch gold stocks. I would look to buy on, you want to see this triggered with a little bit of upside momentum. So I'm not saying buy gold here, but definitely, a rough reference on gold futures if you're looking at front month April, maybe above 1280 or so.
Okay, all right. And anything else on pullbacks? We noticed the pullback in like ExxonMobil, some of the oil stocks here, getting a nice boost in crude. Is there any setups there that you're looking at?
That is, well, the boost in crude and in oil stocks, that's a situation where I would be a little bit careful. This looks like a pullback that is setting up another leg, or at least another attempted leg in the downtrend for crude oil, and that certainly will play over to XLE constituents, OIH certainly. So I would be very cautious if you're looking for a spot to buy crude. There will be a spot. I don't think this is it yet, so I would wait on that.
Okay, and you also talk about momentum trades and being a momentum trader, buying breakouts and selling breakdowns. Yesterday, I sold the breakdown in the S&Ps. Fortunately, I got out. You see any momentum trades setting up today?
I don't think this is really an environment. A part of the task of being a discretionary systems trader is understanding that market regime, understanding that market environment. To me, this is not an environment that, in the big picture, really favors breakout trades, really favors momentum trading. It's more of an environment. The market's been in consolidation since November, December. If you look at the daily chart of the S&P, as long as the market is in that type of consolidation, fake breakouts, fake breakdowns are the norm. That's what we should expect. If you're looking to buy stocks, I think an excellent buy point would be to look for a fake breakdown like we had yesterday. I'd like to see a little bit lower. I'd like to see a little bit more panic to trigger that buy. But this is an environment where, until something changes in the market, you're going to find breakout trades to be pretty difficult. So I would focus elsewhere.
Okay, and then probably the trickiest one, mean reversion. Looking for an overdone move, looking to come back to a stabilization point. Give us your explanation here for mean reversion, and tell us what you're looking at.
Well, the problem with mean reversion, and just to define that for anybody who isn't sure, when we're talking about mean reversion, you're looking for places where the rubber band has been stretched too far and the market is set to snap back. People will typically say overbought, oversold. The problem with those ideas is crude oil is a great example. How long has crude oil been oversold? How long, by any reasonable measures, crude oil been oversold? And yet it keeps getting more and more oversold as it trends. So if you need to define your time frame over which you trade mean reversion. If you're a short-term mean reversion trader, that really is the arena of the intraday trader. In many cases, you're looking to be in or out within a matter of minutes or hours. If you're looking at longer-term mean reversion, which is at some point what we'll be looking at in crude oil, you need to have a little bit better structural setup. So what we want to see, you usually want to put on a couple more conditions. So the market is oversold. Then the market has you can do something as simple as waiting for that oversold situation to correct. So if you imagine crude oil's been going down, it bounces. Now it's made a pullback that could give us a spot to short. The second time that it goes oversold, the second time that it sells off and goes too far, that might be a better spot to start fishing for long positions. So that is the problem with mean reversion. U.S. dollar is another good example. We have a lot of currencies. We have a lot of things being driven by the dollar. Dollar is probably a little overbought, and you have to say that almost as a joke. The dollar is very overbought. To just run in and short the dollar, but we have a situation here where we were able to identify last week and into the middle of this week, we have a situation where the dollar is probably structurally due for a pullback, and that's likely to be a little bump in the road here for a few days. Then we'll see the dollar resume. Last thought on mean reversion, one of the ways that traditional technical analysis fails, and I say that based on my quantitative work. We're told that everything trades the same. You can trade any pattern in any market, use any tool in any market, any time frame, but there are real differences in the way assets mean revert. And the best example is stocks tend to mean revert strongly, currencies tend to trend better, and the force of mean reversion is much less. So that is also another warning if you were looking to run in and fade this move in the dollar, potentially problematic. So those are the kinds of things we look at and think about.
Okay, all right. And do you trade the equities outright? Do you trade the options markets? How do you execute your positions?
We do pretty much everything, go anywhere. I do a decent amount of work with options. In the options trading, usually what we're looking for are more vol trades than directional trades. Most directional trades will execute outright, either in stocks, futures, or cash currencies for the most part.
Okay, and just looking at today's setup here in the S&P 500 futures, strong move overnight here. Do you use the S&Ps as an indicator at all in your trading, or are you pretty much sticking with your models?
Well, our models give us a read on the S&P, and we understand the price patterns and seek to understand the market structurally. So yes, the way I read the S&P is if you're looking at the futures, we're in a very broad range, roughly call it 1965 to the downside, maybe 2090 to the upside, that high from late December. And we're kind of in the middle of that range. It's very difficult for me to get excited about trades in the middle of this range because I know that the market is likely to have a lot of fake outs, a lot of failures, a lot of reversals. So the two scenarios I'm looking for, I'd either like to see an attempted breakdown that fails, and that would need to be a fairly significant sell-off. So, it's hard to get my attention above 1970. Probably that won't happen today, but if we could get a strong sell-off below that and then a reversal, failed breakdown, that could be a good entry point. The other thing would be to be looking at significant upside. So we'd be looking at probably taking out the December highs. Then we could look to buy pullbacks. As long as we're stuck in this range for the 1 week to 2 month swing trader, I don't really think there's a lot to do in terms of the broad market until we get out of this range.
Okay, just the way that you learned about the markets and anything, is there a particular book or a particular mentor that you had that you'd like to alert our traders to?
Well, I've had a number of mentors, and Linda Raschke was certainly, I owe her a tremendous debt that I could never repay. She was a great mentor and somebody who really helped me figure out the way markets work. In terms of books, not to plug my own work, but I'd recommend my own book, The Art and Science of Technical Analysis, which I think gives a significantly different perspective on the problems of trading, how to develop trading strategies, how to think about the market. It's the book I wished I had when I started out. So
Okay.
certainly love to have people take a look at that.
And final advice for traders.
Manage your risk. Trade small enough. I think most people that really get in trouble, the problem is they're taking bets that are too big for their account size, and you really got to manage the risk.
Okay. All right. Been on the line with Adam Grimes. He's Chief Investment Officer at Waverly Advisors, giving us his trading strategies and perspectives on the market. Adam, thanks for joining us. Have a great trading day. We'll talk to you again soon.
Thank you. Take care.